People don't understand their natural advantages,
Yeah.
and they don't use them. So that's bad, number one. But worse, number two, is if you don't think you're a good ice skater, or if you're convinced you're not a good cellist, you're not going out and try it. But people are buying stocks anyway.
Yeah.
They're not discouraged. They just think it's a gamble.
Most investors lose money trying to beat professionals with algorithms and insider information. You watch your portfolio swing wildly while fund managers collect fees regardless of performance. The average investor earns just 3.7% annually, while the S&P 500 returns 10%. You feel like the game is rigged against ordinary people. But Peter Lynch proved that regular investors have a massive advantage over Wall Street professionals if they know how to use it. The legendary Fidelity manager turned a $20 million fund into $14 billion by shopping at malls and observing everyday life. Today, I'm revealing Lynch's exact strategy that lets you discover winning stocks before the pros even notice them. No complex analysis, no financial background required, just your eyes and common sense. Before we dive into Peter Lynch's game-changing strategy, let's understand who we're learning from. From 1977 to 1990, Lynch managed the Fidelity Magellan Fund and achieved something that seems impossible today. He averaged 29.2% annual returns over 13 years. To put that in perspective, if you invested $10,000 with Lynch when he started, you'd have had over $280,000 when he retired. The fund grew from $20 million to $14 billion under his management, making it the largest mutual fund in the world at the time. But here's what makes Lynch different from other legendary investors. He believed that amateur investors could beat the professionals. While Warren Buffett focuses on understanding businesses deeply, Lynch developed a system that anyone could use, regardless of their financial education. Lynch famously said, "The person that turns over the most rocks wins the game." And that's always been my philosophy. Today, we're going to learn how to turn over those rocks in your everyday life. Lynch discovered something that Wall Street doesn't want you to know. Regular investors have significant advantages over professional fund managers. Let me explain why. Number one, no bureaucratic constraints. Professional fund managers can't just buy any stock they like. They have committees, compliance departments, and investment mandates. A fund manager might discover an amazing small company, but if it doesn't fit their fund's criteria, or if the position would be too small to matter, they can't invest. You, on the other hand, can buy any stock you want, whenever you want. You can invest in small companies that might be too tiny for institutional investors to consider. Number two, no forced diversification. Many professional funds are required to own 100 or more stocks. Lynch himself was often forced to own stocks he didn't particularly like just to stay diversified. You can concentrate on your best ideas. Lynch recommended that amateur investors own between 5 to 10 stocks that they truly understand. Number three, no performance pressure. Professional fund managers are evaluated quarterly. If they underperform for even a few months, investors start pulling their money out. This pressure forces them to focus on short-term results rather than long-term potential. You can think in years, not quarters. You can hold a great company through temporary setbacks that would force a professional to sell. Number four, first-hand consumer knowledge. This is Lynch's most important insight. You experience products and services before Wall Street analysts even know they exist. You shop at stores, use apps, try new restaurants, and buy products months or years before they show up on a professional analyst's radar. Lynch discovered Dunkin' Donuts because he noticed long lines at their shops. He found Hanes because his wife preferred their pantyhose. He invested in Taco Bell after seeing crowds of customers that weren't reflected in the stock price yet. You live in the real economy. Use that advantage. Lynch's core philosophy is deceptively simple. Invest in companies whose products or services you use, and understand. But there's more nuance to this approach than most people realize. Step 1. Start with your daily life. Lynch called this shopping for stocks. Look at the products you buy regularly. What apps do you use? Which stores do you prefer? What restaurants are always busy? Which brands do your friends recommend? Make a list of companies whose products or services you genuinely like and use regularly. This is your starting point for potential investments. Step 2. Apply the cocktail party test. Lynch had a simple test. If you can't explain why you own a stock in 2 minutes or less at a cocktail party, you shouldn't own it. The business should be simple enough that a child could understand it. If you find yourself saying things like, well, it's complicated, but they do something with artificial intelligence and blockchain technology, that's a red flag. Stick to businesses you can explain clearly. Step 3. Look for competitive advantages. Just because you like a product doesn't automatically make it a good investment. Lynch looked for companies with what he called sustainable competitive advantages, which include 1. Brand loyalty. Do customers actively choose this brand over alternatives? 2. Network effects. Does the product become more valuable as more people use it? 3. Switching costs. Would it be expensive or inconvenient for customers to switch to a competitor? 4. Economies of scale. Can the company deliver better prices or service because of its size? Step 4. Check the financials, but keep it simple. Lynch wasn't suggesting you ignore numbers entirely, but he focused on just a few key metrics that any amateur could understand. 1. Is the company profitable? Look for consistent earnings growth over several years. How much debt does it have? Companies with little or no debt are safer investments. 2. Are sales growing? Revenue growth indicates customer demand. 3. What's the price-to-earnings ratio? Lynch preferred stocks with P/E ratios lower than their growth rates. You don't need to be a financial analyst. Focus on these basics and you'll avoid most investment traps. Lynch classified every stock into one of 6 categories. Understanding these categories helps you set appropriate expectations and investment timeframes. 1. Slow growers. These are large, mature companies like utilities that grow slowly but pay decent dividends. Lynch generally avoided these because the upside potential is limited. Think of companies like Coca-Cola or Procter & Gamble. Solid companies, but unlikely to double quickly. 2. Stalwarts. These are large companies that grow faster than slow growers but aren't spectacular. They typically grow 10 to 12% annually. Lynch would buy stalwarts when they were undervalued and sell when they became overvalued. Examples might include McDonald's or Microsoft. 3. Fast growers. These smaller companies grow 20 to 25% annually. They're Lynch's favorite category because they offer the highest potential returns. The key is finding them before they become too large and their growth slows down. 4. Cyclicals. These companies' fortunes rise and fall with economic cycles. Think of airlines, steel companies, or auto manufacturers. Lynch was very careful with cyclicals. The key is buying near the bottom of the cycle and selling near the top. 5. Turnarounds. These are companies that have been beaten down but have potential for recovery. They're high-risk, high-reward investments. Lynch looked for companies with strong balance sheets that were fixing their fundamental problems. 6. Asset plays. These companies own valuable assets that aren't reflected in their stock price. This might be real estate, natural resources, or other valuable holdings that the market is overlooking. Lynch's approach was to have a portfolio mix weighted toward fast growers and stalwarts, with smaller positions in the other categories. The key insight is that different categories require different strategies and timeframes. Now let's turn Lynch's wisdom into a practical system you can use today. Week 1. The discovery phase. Spend a week paying attention to your consumption habits. Keep a notebook and write down. every store you visit, and which ones are busiest. Products you buy repeatedly. Services you use regularly. New trends you notice among friends and family, and companies that provide exceptional customer service. Week 2. Research phase. Take your list and research these companies. Are they publicly traded? What are their recent financial results? Are they growing or shrinking? What did customers say about them online? Do they have sustainable competitive advantages? Use free resources like company websites, annual reports, and basic financial websites. Don't overcomplicate this step. Week 3. Selection phase. From your research, identify 3 to 5 companies that meet Lynch's criteria, that you understand their business model. They have competitive advantages. They're growing consistently. They have reasonable valuations. You would be comfortable holding them for 3 to 5 years. The monitoring phase. Lynch recommended checking your stocks no more than once a month. Focus on, are the businesses still performing well? Are customers still loyal to these brands? Has anything fundamental changed about the company or industry? Remember, you're not trying to time the market. You're investing in good businesses at reasonable prices and holding them as long as the underlying business remains strong. Peter Lynch proved that you don't need Wall Street credentials or complex strategies to outperform professional investors. Your advantage lies in your everyday experiences as a consumer. To recap Lynch's strategy, invest in companies whose products and services you know and use. Focus on businesses you can easily explain to others. Look for sustainable competitive advantages. Keep your financial analysis simple but sound. Think in years, not months. The key insight is that great investment opportunities are hiding in plain sight. While professionals analyze spreadsheets, you can discover winning companies by simply paying attention to your daily life. Lynch's approach requires patience and discipline, but it's accessible to anyone willing to think like both a consumer and an investor. Start with what you know, do basic research, and invest in businesses you believe will thrive in the years ahead. If you found this helpful, hit the like button and subscribe for more practical investment wisdom. Comment below with one company you discovered using Lynch's approach. I'd love to hear about your observations. Remember, the best investment strategy is the one you understand and can stick with consistently. Thanks for watching, and here's to finding your next great investment in your everyday life.